So very, very welcome everybody to the stock and option webinar here. We have some good stuff to talk about. I have Sharon, of course you can record, and this will be recorded as well. So you'll have access to the recording. So you can record it, you're welcome to, but you don't need to because I will record it and post it. So you'll be able to see the recording of this. But yes, feel free to record. Okay, so what I want to talk about, I know, and I give all those permission that hear what I'm about to say to take an hour off of a webinar from Jared. But it's always important stuff. I don't try to ever say anything that is not important, but some of you are very familiar with what I'm going to talk about, and some of you need a little bit of a touch-up. Oftentimes I will determine what I want to do the webinar about, depending on how many questions I get about certain things during the week and so on. This week, it's become pretty clear to me that a lot of people are very unclear about what a covered call is. And so we're going to talk a lot about covered calls. If you feel like you're a covered call expert, which covered calls aren't that complicated. And so if you feel like you don't want to hear about covered calls, I will take zero offense if you say, I'm going to move on. But we will talk about some good things. We'll talk about a couple market conditions and so on. But covered calls are super important, especially with the kind of strategy that we're talking about, right? And so I want to talk about, what a covered call, the best practices for covered calls, what they are, how they work, all of that stuff. We've got to make sure that we understand the ins and outs of covered calls, because if we don't, then this whole strategy that we've been discussing for weeks, where we're putting bullish spreads onto everything and closing out the long portion of the spread, the buy to open put, and we're getting assigned the stock at the sell to open put strike price. That is one part, and that's a big part the broker handles, but then we need to understand really how to trade covered calls as best we can and how they really work. And I'm going to show many of you, most of you, if not all of you, are using Tastyworks to some form or another, and I want to make sure that you know how to do that on Tastyworks. Now, for those that are using the Tastyworks downloaded platform, there's actually some pretty good resources. I don't use the downloaded platform, but you can go to YouTube. Uh-oh, I think my computer's hot again. Tastyworks, I think. youtube.com/Tastyworks. If you go to this right here, you'll see, if the internet wants to give it to us, there is a ton. So for anybody that, boy, that certainly isn't Tastyworks. Is that? That doesn't look like Tastyworks. So let's go here. Tastyworks. So if you go here and just go to Tastyworks platform, I think oh yeah, there we go. The Tastyworks. Sorry, the Tastyworks. So they're the Tastyworks. But anyway, this this channel is super good if you're just saying, you know what, I'm having a hard time kind of getting through some of the Tastyworks things. Or I'm using, I think most of these videos are for the downloaded platform. There's some web-based desktop platform review, pattern trader rules. There's a bunch of great videos in here. So I would have a look at this. Go to this area if you need help with the platform. I'm here and happy to help as much as I can, but this link right here will show you a ton of 1 and 2 and 3 minute videos that will be super helpful in getting you up to speed with how their platform works and any help you need there. Okay. So I want to make sure nobody's getting caught on, the platform itself. If you're having any issues, I've just posted the link, pasted the link, put up the link of Tastyworks video stuff. So again, it'll be a lot of stuff on the downloaded platform versus the web-based platform. So they'll have some good stuff in there. But we do want to talk about the fact that covered calls are super important. And again, I feel like people are having a little bit of, lack of clarity of what a covered call is, how a covered call works, and so on. So we're going to go over this. I'm not going to ask who knows what a covered call is and how to use it and who doesn't, because I know some of you do, some of you don't. What we're doing with our strategy is we're getting assigned stock a lot. Now, a couple of things to know about assignment is with a covered call, you need you need to have at least 100 shares of stock. Now, depending on what stock we're looking at, you know, Delta right here with that's up on my screen, 100 shares of Delta is going to cost you $2,700, right? And you're thinking, oh, geez, I only have $3,000 in my trading account or $4,000. But the thing to remember is you can own 100 shares of Delta for about half that, because, not that you pay half that, but it's only going to tie up about half of that amount in your account, because pretty much everybody has an individual margin account. You should have a margin account. The broker gives us margin accounts. Somebody maybe can educate me on this. I haven't asked the broker about this, and I haven't looked into it at all. I've just seen that I don't have any fees for using my margin. Now, if you're holding a trade that puts you in the negative big time, maybe you've got $10,000 in your account, and you get assigned a position that's $20,000, right? Or $30,000. And the broker will say, okay, you know, we're going to let you hold this position open for a couple of days or a week, but at the end of the week, you've got to notify us if you're going to put more money in or liquidate the position. And they will charge you that if you're holding a position that's larger than your account. But if you're not holding a position larger than your account, if you've got $10,000 in your account and you own $10,000 worth of stock, which is only tying up $5,000, they're not charging you a fee, as far as I know, for that other $5,000. They're just saying, hey, we don't want you to tie up all your money so quick and then you can't trade anymore. So it's beneficial for the broker to say, we'll loan you half of that at no cost so that you'll continue to trade and they can continue to get commissions. So everybody should have an individual margin account. If you do not have an individual margin account, I'd recommend contacting the broker. You can open another account. You can have them switch you to a margin account. You can do all kinds of different things. So give the broker a buzz, and they'll be able to help you out with that. Okay, so far so good. Everyone doing okay? So when we're talking about covered calls, yes, we're going to tie up some cash holding that amount of stock open, but it's okay. You know, it's one thing to say, you know, I've got $5,000 in my account and I currently have $5,000 worth of option trades open, right? Or whatever. You're putting yourself in a pretty tough situation because, you know, you can get margin calls and you get all kinds of things that happen because you're using up too much of your account. But if you have $5,000 worth of stock and you have maybe a $3,000 account, you're fine, because we own, you know, leveraged stock, right? Or non-leveraged stock, the very small leverage, 2 to 1. So if the stock goes down $1, you know, we're going to be down $100 on the trade. That's fine. We're not really risking so much in the big swingy movements, because remember, options are heavily leveraged. And so $1 of movement in an option price is a massive movement, right? $1 of movement in stock price is typically pretty small, unless the stock is a penny stock or something. So, so it's okay to tie up more of your account owning stock than it would be to tie up that same amount of your account owning options, because options are much more volatile. They move a lot more. There's a lot more leverage involved there, and it's a little tricky. So when we're talking covered calls, don't hesitate to tie up half of your account holding some stock positions while we sell options on them, right? So that's one thing to think about, look at, so on. Now, the very basics of covered calls, and I'm not going to go into, you know, I'm not going to pound the basics too terribly much and go through them, you know, a ton, because it's a simple concept, and I'm pretty sure everyone here is mostly familiar with covered calls, but we're going to spend a couple of minutes just making sure that everybody knows what it is, right? So here's a covered call situation, right? I own 100 shares of stock in Delta, right? So I bought Delta at $26. Let's say $26. So here's my Delta trade right here. Is there a drawing tool on here? I feel like there is. Is there a drawing tool? Do we have a drawing? No, maybe we don't. I thought there was. I guess there is not. So let's say that I own Delta at $26 right here. Well, I can sell options on Delta, right? I can sell a call option on Delta. So I own Delta at $26. I could sell a $26 call option on Delta right here. I could sell that $26 call option on Delta and make maybe $182, $183. If Delta goes above $26, it's already above $26. If it stays above $26 and expires up here, then I'll be required to sell Delta at $26. But I get to keep my 180 some dollars in option premium. That's a covered call. Now, if Delta is sitting here at $27, I own Delta at 26, and I sell a $26 option, and Delta goes down below $26 at or around expiration or before, then I get to keep that option premium, that 180 some dollars, and I get to keep my shares of stock. So it's all about that strike price. If we buy stock, we want to make sure we're very, very clear where we own that stock, and we want to make sure that we're not selling options in a position that's going to cost us money, right? If I own Delta at $26, I probably don't want to sell a $23 strike, because if Delta ends up above $23, I'm going to have to sell my stock at $23. Now, I'm going to get a lot of option premium that might bring me back to break even, but you know, we want to make sure that when we're selling, when we're writing covered calls, when we're selling options on stock that we own, we're typically going to sell an option 1, 2, 3 strikes higher than where we own the stock. If you own the stock at $26, sell a $27 option or a $28 option. With covered calls, it is going to very much depend on the goal of the trade. If you're saying, what I want to do with a covered call is just have a safe option trade, which means basically we don't care about owning the stock for any period longer than just that option trade. Because remember, covered calls are the safest option trading strategy pretty much out there. Now, they tie up the most money and they probably pay us the least, all things considered, but they're really safe. And they actually pay pretty well, but they tie up a ton of money, right? You got to have 100 shares of stock in this, or 100 shares of stock in that, or 2 or 3 or 400 shares of stock. So covered calls are expensive, but they're a really low risk strategy. When you sell an option on stock that you own, you cannot lose money on that option unless you decide to close the option out in loss before expiration. But otherwise, you can't lose money on that option. It's impossible unless you unless, for example, you own the stock at $27, you sold the $26 option, and you see the stock all the way up here at $35. You're saying, oh, I'd actually rather hold on to my shares, so I'm going to close that option trade. That if I let it expire, I'm going to have to sell at 26. But if I take a loss on the option trade, then I'm going to keep my stock and just take a loss on the option. And I think this stock's headed for $100, right? Kind of a thing. Otherwise, there's not too many scenarios where you don't get to keep this $180. Either the stock expires, the option expires with the stock above the strike price, and then we have to sell our shares at the strike price and we keep the option premium, or the option expires with the stock below the strike price and we keep our option premium and we keep the stock. And then we can sell an option again and again and again until it eventually gets called away. So that's kind of the basics of a covered call. So knowing where your break even is super duper important. So I own the stock at $26. I own it at $27, $28, $29. Super important, number one. So now that we know where our break even is, we need to have a goal. Do I want to hold on to this stock and just make a little bit of extra money selling options? Or do I not really care about the stock? I really just want to do the option trade. If we don't care about the stock much and we just want to do the option trade, then we're usually going to be selling options at basically the same price that we own the stock, or at current market price, as long as current market price is at or higher than where we own the stock. If we want to hold on to the shares, but we want to make a little bit of money, think about owning a vacation house and putting it on Airbnb, right? You want to keep the house, but you want to make some money on it, or at least offset your expenses. So then if we're saying, I really want to hold on to my Delta shares that I own at $26, and Delta's trading at $27, maybe I'll sell the $31 option. Pretty unlikely to get called away. I'm going to make very little money on that. I might only make, $30, $35 a contract, but I make a little bit while I sit on these shares, because I want to make money on these shares, or I want to hold on to these shares, but I want to make a little bit of money while I keep those. So people always ask me, how far out do I sell an option when I own the stock? 1 strike out, 2 strikes out, 3 strikes out, 4, 5, 6. And it's all, there's no correct way to do it. It's all about the goal of the trade. Do I want to get out of this quick, or do I really want to hang on to these shares? And the more you want to hang on to those shares, the further out you need that strike price to be sold. How does everybody feel? Is anything at all even 1% unclear at this point? Is everybody feeling good about that? That's kind of the essence of a covered call. There's more to talk about, but I want to make sure that up until this point, that makes sense. Because what we're going to be doing a lot of is credit spreads where we sell options. And that credit spread where we sell an option to get in, we get assigned the stock, we need to know how to work a covered call, because that's going to be half of the trade. And half of the trade is pretty importante. That is super important. Okay, questions coming through here. Hold on here 1 second. There we go. Sorry guys, one little thing here. All right. Okay, questions. Janae, when you say higher than you own the stock, do you mean break even? No. When we're just talking strictly covered calls, wherever you own the stock, you want to be selling options at break even or higher than the price you own the stock, not lower than the price. So break even or higher. So those would be two different things. So break even would be if I own the stock at $26, I'm selling a $26 call option. If I own the stock at $26 and I sell a $27 call option, $28 call option, whatever, or I own the stock at $26, it's trading at 27, maybe I sell a 28. So that kind of thing is, so definitely a distinction between break even and higher than where we own it. Does that help? Does that make sense? Excuse me. Amy, does the premium we receive matter, and how far on the expiration date? Good point. Yes, the premium we receive matters a lot, because the closer we sell options to the current stock price, the more money we're going to make, right? So look at Delta right here. Let's say you buy Delta right now at 27 bucks. So we own Delta $27. Where is it? There we go. We own Delta at $27, and we're immediately going to sell options on Delta. So yes, if I'm just saying I don't care about owning Delta, I'm going to sell an option on Delta for right at the strike price. I'm going to make 125, 130 bucks on the trade. Great. I'm not going to make any money on the stock, but I'm going to make 125 or 30 bucks on the option. Now, the other thing to look at here, though, is if we say, well, I think Delta might go up, we're going to be tempted to say, well, I could sell an option right at the money, right at 27 bucks and make $125 on the option, and I make no money on the stock because I own the stock right here, and I'm going to lose the stock right here. So I'm actually going to make no money on the stock, but I'm going to make 125 bucks on the option. If I go one more strike higher, instead of making 125, I make, we'll just say 90 bucks, right? I'm making less money up here, but am I making less money up here? If we look at the math real quick, my trusty calculator, if we look at the math and say, okay, we make 125 or $130 on the option itself, no money on the stock, versus up here at $28, now we're making, we'll just say $90 on the option, 90 plus, we're going to make about $100 on the stock because we bought the stock at $27. If it goes above 28, we're going to be required to sell it at $28, but that's $1 higher than we bought it, and we bought 100 shares. So now I'm only making $90 selling the option, but I'm also going to make $100 on the stock. And so by actually selling the cheaper option, we make, nearly double the amount of money as we would selling an at-the-money option on the stock that we, at the price that we bought it at. Does that make sense to everybody? Does that sound okay? Does that sound all right? Everything good? So far, so good. Peggy, talk about what to do if the stock is now selling lower than when you purchased it. I will definitely talk about that. It's a very good point. Very, very good point. But so far at this point, and Amy, to answer your question, typically the further out you go, the more money you can make, right? If I sell it, but just to say this, on expirations, on where I want a covered call to expire, most of the time I don't want to sit in it forever. I want to get out quick, so I'm going to sell a 15-day, typically around a 2-week expiration. Now, a $28 strike on Delta is going for, let's just say, 90 bucks, 15 days out. If I go to the next expiration, it's selling for a little tiny bit more. 22 days out, we're about 3 weeks out, it's selling for, I might be able to get 110, 120 out of that. So we're getting a little bit more. And the further out we go, the more we'll make. So we go out here 29, about a month out. And now we're talking about, making, instead of 90 2 weeks out, we're 4 weeks out, we're maybe making 130 or $140. But I don't want to sit in a trade for a long, long time. I try to get out of these things. I'm usually looking for about a 2-week expiration. So I'd rather just move on to the next trade and not sit in one for an endless amount of time. Okay, so far so good? Everyone good on that? Okay. Okay, good. All right, any questions on the math, right? We always have to, when we're trading covered calls, we have to think, how much am I making on the option, number one? How much am I making on the stock, number two? Remember, if the stock expires, or excuse me, if the stock price is above the strike price, which is this guy right here at expiration, I have to sell my stock. They're not going to ask me or give me an option to do something with it. They're just going to take my stock at $28 if the stock is above this strike at expiration. If it's below, I get to keep the stock and I keep the option premium. If it's above, I keep the option premium, but I lose the stock at 28 bucks. So as long as we're clear on how that works and what we're doing with that, okay, good. Now, I don't want anybody at all to just trade a covered call. Covered calls are part of our strategy. But I don't want you to ever enter a trade just by buying stock and selling an option. Never, never, never. Enter a trade by selling a put or getting into a credit spread. That's how we want to enter a trade. So never, never, never enter a trade just by buying stock. You've got to sell a put. You've got to trade a credit spread and get assigned. We've been talking for the last couple of weeks about how we do that. So we're never going to buy stock. We're only going to sell options to get into stock. Because when we sell options, that pays us money to get into the stock. That gets us in. If I buy stock, if I buy Delta right now at 27 bucks, that's what I pay is $27, right? If Delta goes down next week, then I own stock that is worth less than what I paid for it, right? Which is going to happen much more often than not. But if I go over here and I sell a put and I say, okay, I'm pretty good to own Delta at 27 bucks. So I sell a $27 put, I'm going to make 120 bucks selling Delta, about $120 selling a $27 put on Delta. Now, if Delta goes up, then I just keep my 120 bucks and it's fine. If Delta goes down, then they're going to assign me shares of Delta at $27, but I get to apply that $120 or that, $19, $20 here. I get to apply that towards a break-even price. So now my break-even price is $25.80, right? So actually I really own Delta down here. So it gives me kind of a pause, rewind time kind of a scenario to get in at a better price. Everyone good on that? So we want to never buy stock. Never, never, never buy stock. Sell options and get into stock at much, much better prices because we're selling options to get it. Good? Everyone good? Good? Okay, so Peggy is asking, what do we do if the stock is lower than where we bought it? How do we do covered calls? So let's just say I bought Delta at $34. And here's Delta trading at $27. It's trading right down here. So I'm just using these kind of as two bookmarks, right? So I bought Delta here, and I'm trying to sell an option somewhere down here, and I'm saying, okay, what do we got here? You know, what's going on? How can I work with this? There's a couple of things we can do in this scenario. What I'll do when I'm in a scenario where I'm just upside down in a stock trade, right? And I say, okay, well, I want to make a little bit of money while this makes its way back. Then what I start to do is sell very short-term options that are 1 or 2 or 3 strikes away from where the stock is currently trading. I don't ever let the stock go above the strike price. I don't want to get called away, because if I have 100 shares of Delta at $34 and it gets called away at $27, I need to know what my numbers are, right? I have $3,400 of Delta, 100 shares at 34 bucks, and it gets called away at $27, then I've lost 700 bucks getting out of that trade. I don't want to do that. But what I am okay to do is say, all right, well, I own Delta at $34. Delta's been kind of bouncing around, not doing much here. Maybe I'll just sell a short-term 15-day $29 option. Here's Delta trading at 27 bucks. I might sell a $29 option and, you know, make 65 or 70 bucks and start chipping away at that $700 drawdown that I'm in until this gets to a point where, excuse me, where it gets to a point where I am, you know, in half the drawdown. Either the stock price keeps going up, or I've sold options enough times that I've eaten up half of that drawdown. So maybe Delta is still at $27, but I've made $300 or $400 selling options, and it's staying below my strike price wherever I'm selling my option, and I'll take a small loss, right? If it starts to go above 29 bucks, I'm going to close this option in a loss. Because if this is ready to run, I want to let it run, and I don't want to have a big drawdown on my short call here, the option that I sold. So just sell short-term options 1, 2, 3 strikes away from, excuse me, from the current stock price, and just try to make some money, right? Some money is better than no money. And if we can sell options 3 or 4 or 5 times, then we might eat up half that drawdown. Does that make sense? Does that answer your question, Peggy? Does that kind of help? How's everyone feel about that? Are we feeling okay? Is it making some making some sense? Oh, what's going on here? Okay, so what we need to be able to do when we're trading covered calls is be able to calculate where our break even is. We need to be able to calculate how much money we're going to make if the stock gets called away at the strike price we're selling. We need to be able to calculate how much money we're going to make on the stock and how much money we're going to make on the option. In certain cases, if a covered call, you know, you get into a covered call and the stock's looking fine, and then the option just, or the stock price just drops, right? Let's say you own Delta here at 27 bucks. That's where we bought Delta, and the stock drops a whole bunch, right? Maybe it drops down to $23. And so now we're going to be about $400 in the negative on the stock position. Now, yes, we were able to take maybe $125 or $130. So then our $400 negative position is really, you know, $275 or $270 in the negative. So then we say, well, maybe I'll just sell another at-the-money option to get out of this thing. And an at-the-money option, as we know, sells for about 125 bucks. So we sell another at-the-money option, and maybe we get called away because the stock goes above, but we just want to get out of the trade. So selling an option to get in, well, let's forget about selling the option to get in, but we sold an option, the stock dropped. We get to apply the money we made from that selling that first covered call to hopefully bringing down our break even. So we own the stock at $27, but we made $125. So now we own the stock really technically at $25.75, right? And so now the stock's down here at 24 bucks, $23. We can sell another at the money option, make another $120, $130 on it. And, you know, and all of a sudden our $400 drawdown is really more like $200 or $150 down. And maybe we can afford to get out at that with a much smaller loss and move on to the next trade. I don't like to take losses any more than I absolutely have to, but you know, every time we take a premium, it brings our break even down a whole bunch. So that's a super important thing. So knowing how to calculate that break even, is ultra important. It's something we want to make sure that we can do, because we're going to do a lot with selling options and writing covered calls. That's thing number one. Thing number two, a question that I do get asked from time to time is people say, okay, I own 100 shares of XYZ stock. How do I attach a call option to that? Well, you don't attach anything to it. If you own shares of something, if you have 100 shares, 200 shares, 300 shares of whatever stock, if you sell call options, the broker is going to associate the call options. As long as you're selling call options on the same stock that you own, the broker is going to say, okay, you own that stock, and so this is a covered call now. So we don't have to kind of tell the broker, hey, I own the stock, and now I'm selling the option. That's a question I get asked quite a bit. It might seem like a silly question, but it's a good question. It's one that I do get asked quite often. If you own the stock, the broker will see that. They'll associate the options you're selling with the stock that you already own. People will say, well, there's a way you can do covered stocks in here, which is a short call. It's a covered call basically. I don't use this feature much because it's kind of strange. I don't like to have the numbers combined there. So I just like to say, I mean, what they're doing on this is they're saying, okay, here's the premium you're going to receive, and here's the strike price. Here's what it brings your price down to. But it's sometimes a little bit confusing for people, right? So Delta's trading at 27.08. We can get, maybe, $1 or 90 some cents or whatever. That's going to bring our stock price down just a little bit. So that's the number they're showing. But I wouldn't do the covered stock strategy. I would just buy the stock and then in a separate transaction sell an option. And that's all you have to do. Okay, and then once again, to do that, if I want to buy the stock, I'm going to click on stock and I'm going to click on buy to open. 100 shares, 200 shares, 300 shares, send and review, done. And then once I own the stock, I'm going to go over here to the table and I'm going to sell an option at whatever price I want to sell that option at, knowing where my break even is and knowing how much money I'm going to make or risk. And that's how I'll do it on the platform. So really simple to do on the platform, but I like to do it once again in a separate kind of way. Just buy the stock, sell the option. But there is the feature to trade a covered stock and just, wham, bam, all at the same time. Okay, does that make sense? How does everybody feel about covered calls? So being able to calculate your break-even is important, and I'll talk about this for a moment. One of the reasons that I talk so much about calculating your break-even is because if you buy stock, or if you sell an option to get into stock, like I want everybody to do, I want everybody to sell an option to get into stock. So if you do that, then we need to be able to calculate where that break even is, right? So that break even, let's see, where's my, that break even is going to be right, hold on here, let's go back to reasons. That break even is going to be this guy right here. So remember this example from that other person that took that rig trade. So if we, wow, what's going on here? Did it come up? There we go. So if we start with a credit spread, right, and we say, okay, I sold the sold the $6 put, bought the $5 put. Stock goes way down to $2. I get to take all that profit, that $371, plus I get to keep all this profit from the short put. So I have $700 and whatever dollars on that. So that's going to help me calculate my break even, right? So because there's two contracts here, there's two contracts, and I say 371. I know we've done this before, but it's important to know 371 plus 366, right? 371 plus 366. Because I'm going to close this option in major profit. And and when I do that, that makes this a naked put, and I get to keep all the credit from the naked put, but I also get assigned at the price, the strike price of the naked put. So I get to close out with $737 in profit, but that's for two contracts. So that's representing, two contracts. So we have to divide that by 2 to get how much money it's going to actually go towards each share. So that's $368.50 per contract, or $3.68 per share of stock. So now $3.68 minus the $6 where we're going to get assigned 200 shares is $2.32. That's what our break even is. So we must, excuse me, good heavens, I think I've been talking too much today. So we must be able to calculate that break even. We've got to be able to calculate that break even, or else we're going to be scrambling to make sense of this whole strategy. Okay, so far so good. Everyone okay with all that? It's all just simple math. You just need to know which numbers to look at. Amy, so we must hold on to the covered call until expiration, not before, right? Well, you can close a covered call before expiration. If you bought Delta at $27, let's go back to our trusty example here. You bought Delta at 27 bucks and it's trading at $27. All of a sudden, Delta's down at $26. And you can make $125 on this option, but Delta's down at 26 bucks, and you're thinking to yourself, I might want to do something with this before. Well, if the stock's going down, the option's going to be gaining value more quickly. So maybe you have 2 weeks left on your expiration, but you might be looking at $50 in profit on that option. And you could close it out and take the 50 bucks or $40 or $60 or whatever's there. So you can always close an option anytime you want. It's just when you close an option, what you see is what you get, right? If you are okay selling Delta at $27 and Delta has run all the way up to $33, you will keep your option premium if you let it expire. If you close your option early, you're going to take a huge loss because you get to keep the stock at a much higher price. You're going to take a big loss on that option. But if you let it expire, then you will close that option out with profit. So if you close early, you can always close an option early, but whatever profit or loss you see is what you get. Okay, how's everyone feeling about all of that stuff? Pretty easy to do a covered call on the Tastyworks platform. It's really good to know how to do it. It's really good to do it. It's really good to be able to calculate that break even. Remember, don't ever, ever, ever buy stock on its own. Sell puts. Sell puts. Sell a bullish put spread, sell a naked put to get into the stock. That's what we want to do. But at the same time, we've talked about that strategy a lot, so we got to make sure that we're doing that. But right now, I think it's worth, I've had this discussion many times this week with many people, it's worth having insurance right now. So if, for example, you think, well, if I get into a credit spread and this thing fumbles around a little bit and I end up just having to take the profit from the credit spread, which is pretty minimal, that's a bummer, and I want to just sell naked puts because I can be more profitable doing that. That's fine, but you're taking a lot more risk. And we're coming into politically charged times where elections are coming up and all kinds of things are happening. So it's good to have the insurance of selling a credit spread, ultimately closing that long put, taking profit on that, leaving the short put to get assigned, and going that route. So that's how I want everybody to get into stocks. Sound good? Does that make sense? Okay, I won't keep you guys any longer unless there are any questions. I will take any questions at this point. Was that helpful information or is that old news for all of you guys? What do you think? Did everyone pick up something? Does anybody have anything that's unclear they want to discuss? Anything you want to talk about? I am all ears. Thanks, Lee. Nice to see you, my friend. Okay, anybody? Anything else? Thanks, Sharon. Glad you could make it. Anyone? Okay, good. All right, guys. If anyone's in the process of typing a question, please continue and I will answer your question. But thanks, Janae. Thanks. So if you have a question, please type it over. But that's kind of the route that we're going to be on. I'll record this and post it, of course, so you guys can review it, and it should be good. Nice to see you, Ken. Ken, which Ken? Ken 2715. Which Ken are you? Oh, hey, all right. Nice to see you, Ken. Glad to have you with us. Thanks, guys. Yes. Oh, thank you, Sharon. That's very nice of you to say. My family is beautiful. I'm the duckling in there, but you know what? I'm glad they keep me around. Peggy, yes, start with a naked put or a credit spread, either one. Right now, I would say start with a credit spread, bullish put spread. I don't want anybody taking a bear call spread on anything right now. Bullish put spread, give yourself 30 to 45 days of expiration, bullish put spreads only. Do not sell a call and buy a call. Only sell a put and buy a put. And then we'll sell calls once we own the stock. So yes. So either way, you can sell a naked put or start with a credit spread, but I think it's safer and better to start with a credit spread right now. If stock price is 27, sell a covered call at 34, will be assigned to buy 34 when the stock reaches 34. No. If the stock price is at 27, you sell a call at 34, you're not going to make much money on it, but you would be required to sell the stock at $34 if it got up there. If you own the stock at 27 bucks, for example. So no, when you sell an option, you're never required. When you sell a call option, that's getting you out of the trade potentially, but you won't be required to buy anything when you sell. But if you sold a put, for example, at $34, and and the stock stayed up there, or the stock stayed down here, you would be assigned at $34, but you would get a whole bunch of credit, and it would bring your break even down a lot. That's kind of what you're asking. But yes, when you're selling a put or selling a credit spread, just sell an at-the-money put. If Delta's trading at $27, sell a $27 put, right? Sell a $27 put, buy a $26 put. Do that. Go out, 30, 45 days. There's 36 days. That's looking pretty good. Make some decent money on that. That's paying pretty well, right? 63 cents for a $1 strike there. It's pretty good. So that's what I want you guys to do. Okay, any other questions? Any other comments? So 30 to 45 days out on the credit spread. Let's get assigned. Let's all go home with a whole bunch of money. Okay, folks, I'm gonna go finish packing and get myself ready for a little trip tomorrow. But if you have any questions, we'll cover it. No webinar again tomorrow or next week because I'll be out of town. But we'll get back to the regular webinar schedule the following week. Mel, darn it, we missed you, man. We missed you. But it's all recorded. I'll have everything posted. We've spent this whole discussion on covered calls, and I think it's been a pretty good discussion. I was thinking to myself when we started this, I'm going to talk about covered calls, and I feel like it's going to be so basic. And as we started bringing up all the details of covered calls, I thought covered calls are simple, but there's a lot of moving parts there that we need to know about. So yes, I hear you, Mel. Too much to do in one day. But that's all right. We got the recording. Everything's good. No problemo, my friend. Okay, thanks, everybody. Have a wonderful, fantastic, excellent rest of your day. For my regular trading members, we'll see you guys in the webinar tomorrow morning, 6 a.m. Pacific, and so on and so forth. So thanks, guys. See you all there. Thanks, Amy. We'll have a great vacation this whole next week. It's going to be awesome. Looking forward to it. Thanks, guys. Take care, everybody.